this the same person? Oh, it is, William. Okay, it is the same person. William has 2 questions. Sorry about that. Let's go to William now. And I thought they were 2 different people, so I was going to lump them into one, but it's perfect, so I can lump them all into one now. So William had asked, is there a direct indicator? How'd you phrase it? I apologize. Is there a parameter in the options tab to indicate only stocks with weekly options? And then you also said, if you have the time, would you mind reviewing the search parameters, technical and option parameters for the 2-week out bull put spread? Okay, so let's just do that. Bull put credit spread search. Now again, this is the criteria that I use when looking at bull put credit spreads. This was based on testing and actual trading from about the past 6 years or so, and going through various criteria sets. We touched upon a little bit. Was it last week, William? I don't remember. I'm pretty sure I heard myself talking about that when I was cutting the videos in one section. So we looked at things such as ran tests at Bollinger Bands, what's good at 70 to 75% probability, 75 to 80, 80 to 85, and so forth. Okay. And so what we came up with is we found, of course, that through testing that the 2-week out consistently outperformed the 1-week out positions. And this goes back to our previous discussion that we had regarding the covered call time frame, and I mentioned that I mentioned that in theory the weeklies will always have a higher annualized return because the options that are 2 weeks out aren't 2 times the premium of the 1-week out series. But what I noticed with these is, and you heard me talk about it too, when you have a loss in a bull put for those unexpected events, you pointed to different days, February 5th through 9th, 2018, February 26th of this year, October 5th of last year, going into that horrendous October, a little pullback in November, then that horrible December. That instant drop, even if you're 5, 6, 7% out of the money, can cause you to hit a 50% loss. On IBM here, we're looking at the 116 2-week out spread for a 16.6% return. 116, 114, 30-cent net credit, roughly 16.6% return. If I went with the 1-week out, I'm not getting half this premium. I might be getting 18 cents. I might be getting 19 cents. Way more than half of the 2-week out spread. But I'm not going to be at the 116 strike. I'm going to be at the 118, the 119, only 3 or 4 points away. So if I'm getting 30 cents net credit on a 2-point spread, my true risk is 170. So if I do take the full loss, which I try not to, that would wipe out 5 or 6 previous trades. If I got 18 cents on a 2-point spread, my risk is still $1.72. I'm sorry, $1.82. So one loss of 18 cents is actually wiping out 10 previous trades. It added up fast. And just going through the markets with the historical tools, it was very hard to keep the losses on the 1-week out spreads to only 50% of the risk because you were closer to the price, and when it fell, you weren't at a 50 or 40% loss. You were automatically at a 60, 70% loss, and it was much harder to keep track of the gains. So that's why, I know, William, that was off topic, but that's why this is set to 8 to 17 days. I found that work better consistently long term. Minimum net credit of 20 cents, minimum goal 9% return, but as you can see, the top 3 are usually in my wheelhouse that I want for an average around a 14.5% gain, the top 3 or 4. Why are there only 5 results? Why are things coming down? There's 2 reasons. Number one, always look for stocks not between now and expiration. I don't want to trade a bull put on stock that has earnings coming up unless I'm really confident in the play that Sam might have been in an Apple, which he did mention in some of his comments that I'm going to read in a little bit, with the Apple earnings that came out. But I'm looking at this for more as a safety where I play earnings unless it's a stock I know. I play it more with a different strategy. But in any case, that's why we're seeing only a few results. Number one, because I'm avoiding any stocks that have earnings coming up, and there's still a lot of positions that do have earnings. And at the same time, volatility has dropped a little bit. I'm still seeing the good premiums that I want, but volatility has dropped. So that combination is only giving me lower volatility across the market compared to what it was in April and May after the big March decline, right? But in any case, still some good positions, good returns there. All right. I prefer the strike difference of $2. In testing, I found out that works better than the 1-point spreads. Even some people say, hey, you can use lower margin with a 1-point spread, but doing the same type of criteria, same exact criteria, and doing a 1-point spread versus a 2-point spread, 2-point spread was more profitable consistently. Why? Because when the drop happens, I'm only down 50%. On a 1-point spread, when those drops happen, you're at almost 100% loss because you're below both strike prices. That's the catch, right? All right, so that's basically it. But the fundamentals and technicals, not too much. Looking for something above the 20-day moving average and a 3-day positive MACD cross signal, meaning the MACD must have been above, it must have crossed above the signal line by at least 3 days, right? And then again, for the fundamentals, basically just avoiding stocks between now and expiration. I did test this with looking at a higher earnings per share growth of 10% versus 5%. And what I found out is that it didn't help or hurt. It didn't change it. The criteria that I was using that were looking for stocks that matched my other criteria, maybe 1 out of 300 was filtered out because it didn't have the right earnings per share growth and wasn't a successful trade. It really didn't change the results too much, so I didn't need to include it, in my opinion. Now, I don't know if it would change it now. Let's go to 5. What the stocks are here with 5 results: Hess, Lululemon, McDonald's, IBM, and Burlington. I don't think McDonald's is at 5% anymore. Watch none of them come up. Oh, no, it was. It was IBM, McDonald's, Lululemon, and Hess. So we just lost one of those by including the earnings per share growth. So it didn't, as you can see, to me, it didn't have much effect in testing, so I'm not using it. But that's it, William. That's what it is. What was more key was focusing and finding the right probability with the right structure and the right time frame, while still looking for stocks that are a good bullish trend and avoiding earnings between now and expiration. I know it doesn't give you a lot of confidence, does it? You're not saying, well, what other research are you doing? Where's the Bollinger Bands? Where's the Fibonacci? Where's this? Keep it simple. If you find something that works and has worked consistently in the right markets, why complicate it? Why filter it too much to only have 1 or 2 results that, yeah, might give you a 95% success rate, where you can have multiple results over various time periods. Kind of running into that right now with a specific search a gentleman wants to do and test for us, but the criteria are very strict, and half the time no results come up. They're just not there for what he wants. So we're tweaking it a little bit and going over some other ideas. Now, second question. We call this, I didn't make a change, but this is the default weekly bull puts that we're talking about. The search that we have here on PowerOptions, it's a weekly bull put screen. If it's a weekly bull put, and I've already explained why I'm going 2 weeks out instead of 1, but if it's a weekly bull put, why am I looking at all expirations instead of all weeklies? Here's the trick. All weeklies in the search is simply a designation, a flag from the exchanges of anything they consider to be a weekly option, which means anything that is a non-standard or monthly expiration. Okay, so why would I set all expirations in the filter instead of all weeklies? Well, this is a weekly, that's true. It would come up if I chose all weeklies. So would the 14-day out if I chose all weeklies. But as I come up to the August 21 cycle, it wouldn't appear. So if I'm running a weekly search on August 16th for the 21st expiration, and I'm using the all weekly screen, nothing would come up because this isn't flagged as a weekly. This is a standard. It wouldn't come up. Okay, so then you see here, you've got the 4th weekly, the next weekly series, and then the standard. Okay, so the only ones that would come up if you chose all weeklies are anything designated by the exchange as a weekly. You'd miss 1 week if you were using that fashion. You wouldn't see results in that case. So that doesn't answer William's question. What I'm showing everyone is how I would use this search to create a weekly screen. Even if I wanted to go 7 days out in time, I just go 1 to 8 days out instead of 8 to 17. Perfectly fine. But that just means that you're including the standard expirations. Now you want to know, you only want to trade positions that have weeklies, meaning that when I get to August 21st expiration, you don't want to see all 4,500 optionable stocks and indexes. You just want to continue the pattern of the positions that have weekly options. Just go to List, William, click the drop down, And stocks offering weekly options. Just screen against that list. That's it. That's the best way to do it. We update that every week. It was last updated 2 weeks ago, I think. I don't know if anything new came in. It was last updated 2 weeks ago. So this is all stocks, indexes, and ETFs that offer weekly options. Yes, in my default, I'm excluding indexes and ETFs from the bull puts to get the better return for the underlying stocks. But this one here, just selecting stocks offering weekly options, and then using all expirations in the time frame, you'll only see results that have those 7-week out cycles on a consistent basis, William. I know I kind of went around there, but I wanted to share some of the other features of why we're using all expirations instead of all weeklies in the drop-down menu in that case. All right, so just use the list for all stocks offering weekly options, and that will do it for you. Okay, all right. And again, it will be, oh, yeah, McDonald's is looking attractive for a bull put. I'll check on Monday. I'm going to be honest with you. I'm going to be open those on Monday if I'm opening new positions in that case. All right. Okay. Okay, yeah, Sam offers a thought. TQQ is a fund. It's holding the FANG stocks in that case, essentially. Okay. You did a bull put in Facebook, Sam, and PayPal today. That was the other one that was, no, that was in the covered call screen I think we were looking at. No, it was the Mary put. It was the Mary put. That's when that came up. You said you did that. Okay. All right. And the oil demand will come back, Sam Fields. I believe you. It's just a question of timing, I guess. Okay. All right, 7, and this week was the 7th bull put on Apple that were all good for Sam with no loss in that case. Okay. All right, fantastic. Just remember that Apple announced today the 4-to-1 split. So at the end of August, they're going to split 4-to-1, I guess, to promote liquidity. So they'll be at, what, 100? No, actually, now they'd be at 106. Yeah, 106.50 or something like that if the split was today. I don't know if they're going to, they're going to base it, I guess, on what the price is at the day, but they're doing a 4-to-1 split coming up in the end of August. That was announced with the earnings today. Fernando, I'm sorry, did you say Strangle or Straddle? It doesn't really matter. I just didn't see it. I saw it and it accidentally got deleted. Fernando wants to know, how can he remove, why not just use TQQ? Vega exposure in a long straddle or long strangle position. Let me go out to September here, 35 days. We'll do TQQ. Let's just do the straddle. Okay, now what is he talking about here, okay? He's going a little bit in depth. I'm not saying that, Fernando. I mean, for others of you who are not familiar with the term, he's going a little bit in depth. But here is a long straddle position, terribly expensive. Bad view. Let me use Apple. That's just too wide of a range to really get a good view of it. And I'll keep the same time frame, 35 days out, and we'll go at the money. It's going to be expensive, but I think we're going to get a better profit and loss chart percentage-wise instead of not being able to see where it goes into profit. Okay. A little bit better, but still expensive. In any case, let's just should take a different one. I'm really sorry, folks. For the example, so we can see the graph pretty well. I should be doing a strangle, not a straddle anyway, but that's okay. Never too expensive craft. All right, much better. Fernando and I had a coaching session yesterday afternoon, a great coaching session. Fernando's out in Italy, so it's always fun. So we, we kind of do a go-to-meeting when I talk to Fernando so he can see my screen frequently. So we have good conversations there. What he wanted to clarify for me was the effect of what I had referred to a couple webinars ago and again a little bit last week about why is it so important to worry about volatility on a long option position. And we illustrated it with a calendar spread, but it also relates to anything, a long strangle, a long straddle. And I know some of you, it might be obvious, but this graph is showing us what the expected return would be if the stock hit a particular price on a particular day. Let's say previous to expiration, yeah, we go halfway. We go to about 8:20. Okay, so in this case, my call currently has a volatility of 0.2839, and the put has a current volatility of 0.247. If the stock moves up to 38 on 8/20, another 20 or 15 days before expiration on September 4th, then the Black-Scholes model tells us, hey, we'd expect this 34 call to go to 402. Well, that makes a lot of sense. It's almost right at intrinsic. And the long one is supposed to be at $1. Well, that makes sense because it's so far out of the money and these volatilities are low. But what if, because earnings were coming up or earnings had recently come out, the volatilities of these two options now were at 0.55. Okay, so now it says, oh, but if it goes up to 38 in the next 20 days, well, you're going to expect a little bit higher, 434 here, and this is going to keep 33 cents. You're looking at a potential profit of $242. But it's based on an event coming up. That's why the volatility is inflated. So what do? We check the volatility range, let's say, of the put. I'm going to go to Research and Options Research. This takes us to the full data we have for the put. And then over here on the right-hand side, I see the percent implied volatility range here and the total range. It was up to 0.5826 recently with the earnings that came out Tuesday or Wednesday. And now we're at a zero implied volatility range because it's back to the low. But let's say I was entering this straddle before the earnings came out, and I entered it at a volatility of 0.58. Why I want to come here is because I have to estimate what this position is going to look like if the volatility drops back down to zero. Not zero, I'm sorry, it goes back down to its low after the event happens. I have to know to look in a calendar spread or in these types of strangles that I need this calculated at 0.25 or 0.247, whatever value I want to use. I chose it so we're not seeing a big move, but a profit of 242 down to 177, that's about 70 cents. That's a significant percentage change based on this. What does this have to do with Vega? Well, Vega is the Greek that measures what you'd expect your option to change price-wise based to a 0.01 change in volatility, in implied volatility. Okay? So if you're going into the realm of Vega hedging, Fernando, because you're concerned about changes in the volatility or the implied volatility of the options, what's going to happen is you're going to have to do an opposite transaction where the Vega change benefits you instead of hurting you, i.e. sell a premium, sell a call, sell a put. What's the problem there? Now you've capped the gain one direction or the other. Are you still in the trade you want to be because you're trying to enter this Vega hedge? Okay? The other idea is to consistently roll up the calls and the puts or roll down the calls and the puts so that you stay in a specific time frame or specific quote-unquote Vega ratio or Vega frame by adjusting the options and not necessarily selling. But again, now you're asking yourself, does the new change your positioning to reposition Vega still match your goals for the expected profit of the original position? Or by doing this quick kind of Vega fix, shorter term, longer term, whatever, by selling premium that would change the Vega effect, just because you change the effect of Vega, is this the position that you want? Is this the structure that you want? Is it worth it to change your expectation of original expected profit to hedge against implied volatility shifts? I don't know. If you're expecting a large implied volatility shift, I might suggest buying shares of UVXY or the VIX calls, which are better priced now in that case, to hedge against volatility shift in the market against your other positions. But trying to get into in-depth Vega ratios, Vega scalping, and things of that nature, I'm worried, Fernando, you're going to put yourself into a position that you're not going to like. Or you're going to be rolling the long calls and long puts to a point where you're not at the target point you wanted to be for the max profit or expected profit based on where you originally planned the stock was going to move. You can trade yourself out of a position by overthinking it easily enough. All right. Chuck says, Michael, can you confirm that an option with a distant expiration date, say 1 year, that is so far in the money is almost full of intrinsic value won't be affected by IV over the life of the option? No, it will be. Okay? Wild swings, Chuck, it will be. Okay? Again, perfect example. Let's go back to the custom spread tool. Fernando, we might have been discussing this on ours. I can't remember. I used an example of an in-the-money option far out in time during a coaching session this week that was straight intrinsic value. And I thought we were using even just the October. It was really close, wasn't it? Where did we end up here? 34.60 today? 34.38. Okay, so it was probably further out. But that's okay. That's it. That's pretty close. 27.50 call is pretty much at intrinsic value for KHC, for Kraft Heinz. Okay, so a low volatility, 0.4237, is priced at 729. Now, Chuck, your assumption is correct, meaning what? So it's at 740, the stock's at 34.38. We're looking at the 27.50. So yeah, it's about 34.90. I know it's 60 cents higher. But in this case, if it drops back down to the norm of the near-term options, by the way, it's interesting, isn't it, that the options that are out to January for Kraft Heinz are at around 0.35, 0.36, and the near-term volatilities we just looked at are at 0.24. That's kind of interesting, isn't it? There's a lot of fear still out in the market long-term. All right, long story short, we're a little bit under $7 in the money here. We're at the 27.50 strike, and so we're at about $7.80. No, I apologize. 27.50. We're at $6.80. My apologies, in the money. So dropping the volatility down would put us right at intrinsic, but we're not there. We're at 740. So okay. Chuck's question is, look, if this is trading right at intrinsic, 688, because the volatility is so low, if it drops down to 0.05, then it's not going to be affected. You're right. But again, the volatility to go that low, to go so deep in the money to have so much intrinsic value where there's no time left on it either means there's little to no activity, open interest, or volume. Or it does mean that there's a low volatility to begin with. So to get to Kraft's, and this is not maybe as deep in the money as you mentioned, Chuck, but to get to intrinsic value in Kraft, I had to drop down to a volatility of 0.10. For a volatility, an implied volatility on an option to continue to go down, on this case on Kraft, from 0.10 to 0.07 to 0.05, you know what would be happening? Nothing. Absolutely nothing. You say, oh, well, that could mean the stock is going up. Well, if it's going up and coming down, that's actually going to increase the volatility with the movement. If it's going lower left to upper right, eventually people are going to start speculating and buying in puts, which will actually increase the volatility on the calls as well. This means nothing. This means Kraft has been staying at 34.38 without movement whatsoever for the past month and a half to 2 months, which means that your long call is pointless anyway because you're not getting any gain on that position. But you're correct. If you're down this low and you're just an intrinsic, a drop in volatility shouldn't affect you. However, what you may see is a starting, terrible word, is what you may see is a start of the bid-ask spread widening where the bid is less than intrinsic. Okay? That can happen on your options. You're holding a long call position that's out in time and it's in the money slightly. Okay? And the ask, oh, okay, this isn't the one I was looking at. I'm sorry. I was looking at one earlier today. I was in a married put that's in the money now. The stock's well below. So this is about $8 in. But I was looking at one where the natural bid price was $2 below intrinsic and the ask price was only $1 above. So there was still time value. You're not going to get filled, and you're not going to be able to sell it. I'm sorry, you're not going to be able to buy it at that lower range that's below intrinsic. He's forcing you to sell into that and to buy into this higher price, okay? And that can happen. What does that mean when that happens with a deep in the money call where the bid is less than intrinsic and the ask is time value on it? In that case, it means if you're trying to do anything to that option, he's trying to give you the worst possible deal. Never settle for less than intrinsic but you might not even get filled at intrinsic. It makes it a little bit more difficult in that case for something that's that deep in the money. But Chuck, you're absolutely right. If I'm already down, as we saw in that craft position, to the point where I'm trading right at intrinsic value because of such low volatility, any further drop in implied volatility should not change that. I should be able to get intrinsic back. I may see a bid that's lower than intrinsic and an ask that's slightly higher, but I should still be able to get intrinsic for that option at that time. But the implied volatility shouldn't affect it. Hopefully you're lucky and it jumps back up to 0.55 coming around the next cycle, and you get 70 cents, 90 cents increase in the premium there in your favor with the increase in implied volatility. But take advantage and sell it then rather than go the other way, rather than hold it on for too long in that case as well. Okay, yeah, so that was similar to the discussion we had a little bit last week about calculating the returns for a calendar call spread, and also looking at sort of the conversation Fernando and I had yesterday in relation to the, in relation to the volatility and the Vega effect, meaning the change in volatility, how that relates to a change in the option price. That's known as the Vega Greek as well. Okay. All right. So yeah, and that was a similar question to what Fernando was asking yesterday. We did it backwards. So I showed Fernando first why it was important that he had to be concerned when he first comes in and sees a high volatility of 0.6, but then he has to look at the research to realize that it might revert back to the low, and if that low is at 0.25, he'd expect a vastly different return. But going the opposite direction works the same way, doesn't it? If I start off at 0.25 and I'm just barely at intrinsic, a change in implied volatility might help the position, and I can use the tool to plan for that as well. Okay, I just want to remind everyone that today's material, my thoughts on your questions, designed for educational purposes, increasing investing performance and knowledge of options, options investing, options trading, and options specifics. Any stocks or options discussed today should not be taken as direct trading suggestions or recommendations. Earlier on, we had talked about how the bull put credit spread, Sam said the one on the McDonald's looked attractive. I'm not going to necessarily open that on Monday. I'm going to see what comes up in my results, maybe to make a trade on Monday or Tuesday. We had talked a little bit about PayPal because it came up in the married put screen. I'm not going to open a married put on PayPal today, or on Monday, I should say. Any stocks or options discussed do involve risk. Options do involve risk and may not be suitable for all investors. You like some of the tools you saw today, the default searches we talked about for the naked put weekly picks of the day, covered call picks of the day, weekly bull puts, and much more, creating that basic search that we did as well. Simply go to PowerOp.com, put in your name and email address, and you'll have full access to the tools for 14 days. No credit card required. After that, our subscriptions start off at just $45 per month, but we do offer different levels of service. You want more access to back testing and historical data, or the real-time service as well. We already talked about you can access the webinars page at any time, powerop.com/webinars.asp. A lot of our videos, all of our videos, anything I do video-wise is posted to YouTube. Some are posted on PowerOptions. All of them are posted to YouTube, so you can always follow us on YouTube to get notification when a new webinar, a new archive, a new video has been posted. Of course, you can also check us out at the blog, blog.powerop.com. If you think of any other questions over the weekend or later on, remember you can send me an email at any time to support@powerop.com or support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. And of course, trial members and subscribers, you can always schedule one of those coaching sessions as well. All right, William, Sam, everyone who joined us today, Pat, Pierre, Edison, so many more. Thank you all for joining us. Have a fantastic weekend. Thank you all for your questions. William says good night. Thank you. Thank you, William. Thank you, says Sam. Have a nice week. Interesting Gamma talk. Was good to know. All right, Sam, excellent. That was the Vega talk there. Gamma's a little bit different in that sense. The delta, Gamma is the movement of the delta. How much you expect delta to change based on a 1-point movement of the stock. That's your Gamma, and Vega is based on the implied volatility. Oi! And you meant Vega, I know, but oi. So it gets me confused too, folks. Trust me. Sometimes it's all Greek to me too. That's great. All right. Okay, Ron. Oh, Ron, excellent. Yeah, thank you, Ron, for joining us. I'm glad you made it. Enjoy your weekend as well, Ron. You take care. Okay, you got a long weekend in Canada this weekend, William. That's great. So hopefully I'll get some of these videos up and you'll have more time to go through it later on as well. All right. And Pat says, be safe and have a good weekend. Yes, everyone, be safe. Practice your social distancing. Wash your hands, of course. Be safe, but also still enjoy yourself as well. I'll get these webinars posted together for you and let you know as soon as they're available on PowerOptions or on YouTube. Take care, everyone. Have a good night. Have a great weekend.